Hello everyone, good day to you. Hi, my name is Atanalatule and I am Igcse Business Management Faculty at Igcse Online Academy. I have 10 years of experience and I've been working as an examiner for the past 8 years. I'm a teacher in Igcse Online Academy, and Igcse Online Academy is a registered organization that have taught more than 580 students across the world. Please do visit us at www.igcseonlineacademy.com to check all the courses details and online tutor packages. Follow us on our social media handles, Facebook and Instagram, to get daily updates on live section, infographics, and memes to relieve your stress. Let's begin this section right now. I welcome everyone online. We are looking at a topic in business management that says business cost and break-even analysis. Business cost and break-even analysis. And we shall be looking at the following objective of the lesson. We shall be looking at the definition of cost, the classification of cost, meaning of break-even, how to plot break-even, uses of break-even analysis, and we shall be looking at how to calculate break-even. Without further delay, let's start the lesson. When we talk about cost, we are simply referring to what the business incurs in the production of goods and services. Every business must incur cost, and it is the responsibility of management to see that their cost does not surpass their revenue. The maximum aim of every business is to maximize profit. And that is why managers must try everything possible to minimize cost in order to maximize this profit. And like I said earlier, costs are what the business incurs in the production of goods and services. And if the business must maximize cost, the management must keep a sharp eye on their cost. But first thing first, what are these types of costs? Costs are divided into two, at least for the purpose of this lesson. There are two main types of cost. We have the fixed cost and we have the variable cost. Fixed cost, they are the kind of costs that do not vary with the number of items sold or produced in the short time. In other words, fixed costs are the kind of costs that you incur whether production takes place or not. Whether you produce or not, fixed costs take place. Another word for fixed costs, they are overhead costs. They have to be paid, whether the business is making sales or not. They have to be paid, they have to be incurred, whether production is taking place or not. But when we talk of variable costs are the kind of costs that vary with the number of items sold or produced. And we call them direct costs. Why do we call them direct costs? They have direct link with the production. In other words, when the production increases, this cost will also increase. When the production reduces, this cost will also reduce. That is why we call them direct cost. In other words, they are directly linked to the production or the sales. So if sales increase, this cost will increase. And the summation of these two costs is what we refer to as total cost. Variable cost plus fixed cost equal total cost. We are dealing with these three kinds of costs because of this topic, break-even analysis. What are the examples of fixed cost and variable cost? Don't forget, fixed cost don't change, but variable cost change. Fixed cost don't change, but variable cost change. Examples of fixed cost are rent you pay on a shop. Whether you sell or not, you are going to pay the rent when it is due. Whether you sell or not, you are going to pay salaries. Whether you sell or not, you are going to pay insurance. Whether you sell or not, or you produce, you are going to pay for the equipment. Advertising, market research, transportation of ingredients, bank charges, utilities. All these costs are fixed. Like I said earlier, they do not change in proportion to your production or sales. They are fixed. Whether there is a production or not, they must be incurred. But when we talk of variable cost, they vary according to your production by ingredient. The production level will determine the ingredient you are talking about, which is raw materials. You are going to pay your taxes. If you don't produce, there is no tax to pay. You are going to pay for office supplies. If there is nothing to produce in the office, if there are no services to render in the office, then you don't have any office supply to buy. What of production wages? Production wages are the wages you pay to production workers. So when there are productions, you have to pay wages. If production does not take place, then no wages will be paid. What of transportation of goods? Don't forget, this one, transportation of ingredients, is quite different from transportation of goods. When you transport goods, you only transport the good you have produced or the good you want to sell. If I have not produced any good, then there will not be need to transport the good. So the transportation of ingredient talks about the transportation of raw materials, input, while the transportation of good talk about the transportation of output. And output comes after production. So these are the examples of the cost we shall be looking at today. So what are we saying in essence? Every business must make profit. And how do you make profit? If what we sell is more than what we spend, then we have a profit. If, in other words, if our revenue is greater than our cost, we have profit. If we sell more than the cost, then we are profitable as a business. For example, the total cost of producing 10 vehicles stands at $2 million. And we've sold them at the rate of $2.5 million. Revenue is more than the cost, and we can have profit, or we say we have profit. But if we spend more than we make, then we encounter a loss. In other words, we have produced 10 vehicles at the rate of $2 million, but we have only sold them at the rate of $1.8 million. You need to ask yourself, are we making profit or loss? Quite simple, we are making a loss. Why? Because we have spent more than we made. So every business must have revenue higher than the cost. That is very important. Revenue needs to be higher than our cost. The question is this: when then do we start making profit from our total cost? And that is where break-even analysis comes in. That is where break-even analysis comes in. Break-even analysis is the calculation that shows the selling point of where we start making profit. In other words, break-even analysis is the calculation or the graph that shows the point at which the total cost equals the revenue. Simply put, break-even point is where your total cost equals your revenue. At this point, you don't have profit and you don't have any loss. I can say it again. At this point, you don't have profit or you don't have any loss. That is where your total cost equals revenue. Let me give you a good example, the one I've been using. We produce 10 vehicles with a cost of $2 million, and we have sold 8 vehicles at $2 million. The eighth vehicle is our break-even point, which means by the time we sell the 8th vehicle out of 10, we have the total cost is equals revenue. And at that time, the business has not made any profit. The business has not made any loss. So the cost equals profit at that level. Now, how do we calculate break-even point or break-even analysis? This is the general background or overview of break-even analysis. At this point, where we have the BE point, that is the break-even. But how do we get to this place? Let's take an example. Let's look at this graph. This graph was picked from our textbook, 4th edition, the 5th edition of Business Studies, Carrie Burlington and Peter Stimson. This is the textbook I want to advise that we get. It's very good and straightforward for students. Now, look at this table. We have to fill this table. How do we calculate our break-even point? Let's start by plotting this figure on the chart. We've been given our fixed cost. Our fixed cost is $5. Fixed cost is fixed irrespective of whether production takes place or not. Then our variable cost is $3 per cake. In other words, for every cake produced, we have spent $3. Then our selling is $8 per cake, the selling price. We have to fill in this table. Now, at unit 0, when there was no production, we must have fixed cost, and it is 5,000. But the variable cost will be 0. Why? Variable cost is in proportion with production. If we don't produce, the cost is 0. If we produce, the cost will commensurate with the production. So after filling all this, we should have something of this nature. Now, look at our fixed cost. Our fixed cost is $5,000. When we didn't produce any cake, we incur 5,000. When we produce 500 cakes, we incur 5,000. When we produce 1,000 cakes, it's still 5,000. When we produce 2,000 cakes, it's still 5,000. Why? It is fixed cost and it is fixed. It is parallel. It does not change. It does not change. Now, variable cost will change according to the level of production. The higher the level of production, the higher the variable cost. And that was why when we didn't produce at zero, we had $0. But when we produce 500 kgs, 500 multiplied by 3 will give us 1,005. When the production was increased to 1,000 units, our variable cost also increased to 3,000. When the production was increased to 1,005 units, variable cost also increased to 4,005. How? 1,005 units multiplied by $3. And lastly, when the production was increased to $2,000, the variable cost increased to $6,000. So which means if the production cost has reduced after 2,000, the variable cost will also reduce. Now, we have to get our total cost. I need to let you know at this point that when we talk of break even, we need just 2 lines. The examiner will look for just 2 lines and will look for the total cost line and the revenue line. Every other line are not relevant, except every other line is not relevant except you are asked to identify 1 or 2 things about the lines. But for your break even, you need just 2 lines and they are total cost and revenue. And what is your total cost? Your total cost is FC, which is your fixed cost plus your variable cost. 5,000 plus 0, that is 5,000. 5,000 plus 1,500, that is 6,005. 5,000 plus 6,000, that is 11,000. How do we get our revenue? Our revenue is our selling price per cake. When we didn't produce any cake, we didn't make any sales. But immediately we produced 500 units, we had 4,000 cakes. Why? $8 multiplied by 500 units. When we produced 1,000 units, we had $8,000. And $8,000 selling price. 1,000 units multiplied by 8. And so on. When we produced 2,000 units, we had $16,000. $16,000. The question is this: what is our profit? How do we calculate our profit? Our profit is simply revenue minus total cost. And when we produce 500 units, we never add anything. It was a 0. When we produced 500 units, we were in the loss region. We have minus 2,500. But when we produce 1,000 units, we have a 0. At this point, the total cost, which is 8,000, equals the total revenue. So, which means at point 1,000, we have our break even. But the table is just showing us. The graph is supposed to show us this. So let's go to the graph. Let's go to the graph. Now, let's have our graph. First thing, we need to draw the y-axis and the x-axis, which is our cost and revenue, then our output or sales. And we need to label it according to the data given to us. I've decided to label them like this. You can have your own way of labeling. It is not a must you label in a particular way. First thing first, I have to draw my fixed cost, which is 5,000. It does not change. Even when the production was at 2,000, we still incur $5,000 as our fixed cost. The next is to draw my VC. I'm plotting the table into this graph. My variable cost. The next is to draw my total cost. All these things are according to the table. Please, you will be expected to go to the table to understand how we plot this. We've been able to plot the total cost. The next line should be our revenue, which is this table. Now, what is break-even analysis? Break-even is the point at which total cost equals total revenue. From this graph, we need to ask ourselves the question, where does total cost line meet with revenue line? And that is the break-even point. And it's going to be at this place. Don't forget, as I told you earlier, your focus should be on total cost and revenue, because these are the two lines that will determine your break-even. Where they intersect each other is your break-even point. And from this example, this is our break-even point. This is it here, where they intersect. This is our break-even point. What does it mean? It means that we must sell 1,000 cake before we can break even. What does it mean to a layman? We must sell 1,000 cake, and if we are able to sell 1,000 cake, this business has not made any profit, and the business has not made any loss. But the next cake after 1,000 is the beginning of profit, which means 1,001 cake, that one is the beginning of profit. What am I saying? If the business has passed this 1,000 and we are in 1,005, it means the business has made a profit of 500 cakes. That is what break-even analysis is all about. Now, let's come back to our table. This is our table now, break-even analysis. We must be able to note the table. There is what we call safety of margin, or margin of safety. What is our margin of safety? Our margin of safety is the present sales of the business from the break-even point. In other words, how much have we sold away from our break-even point? Break-even point, margin of safety simply means the actual output, what the business is selling presently, minus break-even output. And this is it. Look at this. We assume that the business is selling 1,008. The business is here. This is the current sales, 1,008. And this is our break-even line. Our margin of safety is simply 1,008 minus 1,000, which is 800. What does it mean to a layman? It means that this business has sold 800 cakes, and this 800 is their present profit. 800 is the present profit. It's very important we have this understanding. The next thing we need to ask ourselves is this: what are the uses of break-even charts? It helps the manager in decision-making process. Another advantage is that the impact on profit or loss of certain business decision can also be shown by redrawing the graph in a case where variable has changed. What does it mean? It shows where or when you break even, when you are going to break even, and you can change it. The truth is this: if the revenue, the selling price increases, let's say from $3 to $5, It means that you are going to break even quickly. You are going to break even early. But if the selling price is reduced from $3 to $2, it means it's going to take time before you break even. So the higher the selling price, the quicker the break even. In other words, the higher the selling price, the quicker you start making profit. The lower the selling price, it will take time before you start making profit. And if the variable cost has changed also, if the variable cost reduces you are going to break even quickly because it's going to affect your total cost. And if the variable cost increases, it's going to take time, a longer time, before you break even. What then are the disadvantages of break-even chart? Break-even works on an assumption, and the assumption is that every good must be sold. And that is why the line is always straight. Another assumption is that the selling price does not change. It's an assumption. Your selling price cannot be fixed. Your selling price will be determined by the forces of market, which is supply and demand, or rather demand and supply. Your break-even chart will not show the wastage from the business. These are the advantages and disadvantages of break-even. The question is this: how do we calculate break-even using formula? The formula for break-even is simply total cost all over contribution. Total cost all over contribution. Then, how do you get your contribution? Your contribution is variable cost minus selling price minus variable cost. Selling price minus variable cost. Your selling price is 8, your variable cost is 3, and it gives you 5 as a total contribution. Then what is your total cost? Your total fixed cost. Once we get the total fixed cost, which is 5,000 all over 5, it gives us the break-even point. And that is why we have it here that 5,000 divided by 5 gives us 1,000, and that is our 1,000 output. I believe that we've been able to learn one or two things from this lesson this morning or afternoon, wherever you are. And before we end the question, we need to check the lesson objective if we have been able to achieve all our lesson objectives. Number one, we've been able to define our cost. Number two, we've been able to classify our costs. Number three, we've been able to explain the meaning of break-even analysis, and we've been able to see how to plot break-even analysis. Number five, we've been able to look at uses of break-even, and lastly, we've been able to see how to calculate break-even with the use of formula. It is very important for us to go back to this video and to check